I think we're really grotesquely overestimating the Trojan horse that is AI. I think we're ignoring the credit risk in subprime, and I think we're ignoring the risk in private credit on the market side. To me, AI, for example, is a bubble, but gold's direction is clearly a symptom of a monetary shift. I have a lot of very smart Bitcoin millionaires who come to Zurich and sell their Bitcoin to buy gold. That's just anecdotal evidence. This anti-dollar, anti-fiat, decentralized crypto is actually being used by the government to create demand for its otherwise distrusted, unloved, weaponized dollar. The monetary system is choking at the end of this credit cycle. So gold has gone from being a contrarian asset to a necessary asset, a strategic asset. China is looking more long-term in a chess-like way of, second, third derivative thinking about hard assets as better collateral than IOUs from broke governments.
Hello and welcome back everybody to Reinvent Money, a podcast about money and power. My name is Paul Buitink and today back on the show is Matthew Piepenburg, former hedge fund manager and partner at Von Greyers in Switzerland. Hi Matthew, good to have you
Paul.
back.
Good to be back, of course.
Yeah, how have you been? It must have been crazy busy at Von Greyers over the past few weeks, especially in October.
Yeah, look, for all of us in the space and precious metals, hard assets, it's quite a year, obviously. We just came back from a big personal event where we got great dinners in Zurich with some pretty big players in the mining space and the precious metals space. And before that, I was in Florida and Palm Beach talking to a lot of investors there. Just everyone has gold on their mind for obvious reasons, but also just concerns about markets, debt, sustainability, all the usual topics that you have been covering, and what's happening with the dollar, what's happening with the markets, what's happening with precious metals, what's happening with debt levels. They're all connected, and you can pull on any string and there's a lot to be found there. So it's just been busy for all of us, of course.
Yeah. But most gold bugs are contrarians, right? Like you're a contrarian, I'm a contrarian. Mm-hmm. Doesn't it also worry you that everyone's embracing gold? Sort of that always gives me a bit of an itchy feeling like, okay, if everyone talks about gold, maybe it's becoming too overcrowded, or it's just...
Right, of course. That's the famous, it was a Joe Kennedy in the 30s, when the shoeshine boy is talking about stocks, the stocks are overvalued. And if the cab driver is talking about .com stocks, that the .com stocks were overvalued in the last bubble. And now there's this conversation. If everyone's talking about gold, it must be overpriced or we must be at peak gold. And of course, I'm going to be talking my book. I have a bias, but gold is not a typical risk asset. It's not a typical bull market because the monetary system is choking at the end of this credit cycle. So gold has gone from being a contrarian asset to a necessary asset, a strategic asset. So I think the price movements in gold, of course, they never go straight up. But the trend for us is very clear. It's a very secular direction. It's a monetary metal. It is a necessary strategic reserve asset. Its rise is not like a typical chart of NVIDIA or Microsoft or Lucent. It's part of a changing global financial order where gold is part of a new monetary system to be determined in what way, as a trade settlement asset, as collateral for repo markets in Asia. There's a lot of strings to pull there. But again, I have a bias, but gold is not rising just because retail demand is chunking. It's actually because of central bank demand, and central bank demand is because faith in the US dollar and the US Treasury has changed. It's not the end of the dollar. It's not the end of the world reserve currency. It's not the end of the United States, but there's clearly evidence of a seismic shift in the global monetary system because of global debt levels. And so when you talk about pullbacks in gold or gold being at peak gold, look, even Jamie Dimon's talking about $10,000 gold down the road. This is not just the gold bug camps anymore. Jeffrey Gundlach is recommending 25% gold allocation. Morgan Stanley, of course, their famous 60-40 stock bond portfolio is now 60-20-20. Goldman Sachs is recommending gold. So again, it's not just the gold bugs anymore. And this movement in the price, which is definitely faster than even I expected this year, was no surprise to us at all after 2022 when we weaponized the dollar. It's a long way of saying this is not a typical asset class or a typical bull peak. It's not a .com stock. It's not the Dow or the New York Stock Exchange circa 1923. This is a very different type of quote unquote price move. It's certainly not a bubble because a bubble is defined by an irrational move with no fundamentals below it to describe it. To me, AI, for example, is a bubble. But gold's direction is clearly a symptom of a monetary shift. And again, it doesn't mean that gold goes in a straight line. You know, in the last major serious bull market that is most on people's minds is 1971 to 1980. It went up 21x from $35 to $850. But remember, in 1975, there was a 25% loss, a negative return. So you can have cyclical downturns in a secular bull market. And I'm not saying the gold only goes up, but I certainly believe it's going to go well beyond 4,000, 5,000, 6,000 in the years ahead. And that's because I have a patient, mathematical, historical understanding of gold, not a trend line following speculative understanding of gold. So I come at it from a very different perspective. And it's not an apology for gold. I really want to make that clear. I am a gold executive. I have a bias, but it's a conviction. It's based far more on history and cycles than it is on just trend lines or the gold price today or yesterday or tomorrow.
Yeah. You already mentioned that you see a bubble in AI. You told me before the conversation that you are seeing all sorts of red flags, not just in the AI space, but also the subprime space, private credit, derivative exposure. A lot of it spells market risk ahead. Could you elaborate? Where could you separate these different risks and how does it feed into the bigger picture?
Yeah, I mean, I never forget that I started my career in Wall Street as a risk asset guy, as a hedge fund guy, long short. Lucky idiot during the dot-com bubble. I've said it a million times. It was just a pre-IPO that I did 20 minutes of research on with Goldman Sachs. I was not an expert on day one, but over the many years that followed, when I got deeper into risk assets and when I ran a family office, I started to look at markets far more, I think, with far more intelligence and better mentors. And I've seen certain cycles, certainly from the dot-com bubble in the late 90s going into the 2000s and then 2008, of course, the great financial crisis. I'm seeing a lot of history rhyming right now. And we could talk forever about cycles and bubbles and peaks and valleys, but getting into specific risk areas, well past the Buffett indicator or price to book or price to earnings. And when you see peaks like this, they usually scare me. But as Jeremy Grantham warned me many years ago when he still ran GMO when I was in Boston, people don't want to look farther ahead than the next fiscal quarter, and they don't want to hear about bad news. And that's just human nature. And they don't want to see risks when things are up and to the right, and they can continue to go that way in this blow-off kind of frothy tops. But I do see three real key risks, getting past this, the concentration risk in the Mag 7 or NVIDIA's market cap or Microsoft or all these other things. And I think one of the things that isn't making headlines enough is just the subprime market, not subprime mortgages like '08, but just subprime everything. And 20% of Americans are basically considered subprime credit. And the bankruptcy in the US is up almost 12% year over year. Auto defaults, Tricolor, Automax, these are kind of small headlines, but I think there is a lot of risk in that subprime credit market, from cars to mortgages, that is just kind of being underreported. And it's just a symptom of cracks in the real economy versus a stock market that's basically Pavlovian, it will follow easy or dovish Fed policies. I've always joked cryptically that you could have a nuclear bomb go off in Cleveland or Detroit and the markets would continue to rise as long as there's liquidity, as long as there's low rates, and as long as there's the promise of QE to come. And I think there's partly that to hide these cracks. The other major crack I see, and Jeffrey Gundlach and the bond market has been talking about this for years, it's just getting worse, is the private credit, or these private credit pools. A lot of private equity funds, venture capital funds, hedge funds have these private loans that with really an unknown class of borrowers. And what I'm seeing that's really creepy in the private credit space is a lot of these borrowers that are counterparties to these funds, these hedge funds, VC, PE funds, are doing what's called PIK payments or payment in kind. They don't even have the money to pay the interest on the debt they owe. They're using equities rather than cash to pay interest. That's always a red flag of something down the road cracking. And I think the third bubble, which will upset the AI crowd and the AI kind of evangelicals, is just AI itself as a bubble. And when I look at OpenAI, for example, and Sam Altman, there's a lot of problems. I see a lot of history repeating itself here. Again, this is my personal opinion, but it's shared by a lot of other traders I talk to in the hedge fund space. Is that you're talking about a company like AI, which has 13 billion in revenues, and the other big one is Anthropic, which is about 3 billion in revenues. But they're selling to these Mag 7 companies that have hundreds of billions of revenues. And Sam Altman at OpenAI is bragging about, he's going to inject 1.4 trillion into the AI spend. But again, his company only makes $13 billion a year in revenues. So how is he going to fulfill that promise? And what's creepy is he's hinting that AI is becoming almost too big to fail. And he really basically said in a recent interview that the government will be the insurer of last resort. So he's taking risk on an asset or on a trend right now that he ultimately thinks the government will be there to support because it is so important. And that narrative that AI is so important is contradicted by a lot of folks I know that are in AI who think it's mega computing a little bit overhyped. But just to get away from that kind of sensational talk about AI, that in 2025, this year, there's been about 330 billion in spend on AI, mostly on data centers. And the companies making this spend are effectively pricing in a 2 trillion in annual revenues to justify the spend. So they're pricing in perfection in AI. And I've seen that movie before in .com stocks, even in subprime stocks in 2000, leading to 2008. I've literally seen this pattern before. And AI expenses by these companies, a lot of these Mag 7 companies, I won't name them all, but you can guess who they will be, are funded in debt, not on the balance sheet. So it's really funded through private credit, SPVs, and circular financing. So it's really no wonder that guys like Buffett are billions of dollars in cash. And, there's Michael Burry, of course. He's called 30 of the last 2 market crashes. He's kind of a cry wolf, but he's kind of on the spectrum for being so brilliant that he can't understand why markets don't respond to these rational things. But he's 80% short AI. You can say, so what? That's just Michael Burry. I don't. I think Michael Burry always sees years ahead of what's already a problem. And there's a major issue in circular financing with AI as well. And at the center of this circular financing storm, of course, is NVIDIA. NVIDIA would invest in OpenAI, which then invests in Oracle or Microsoft for AI models. And then Oracle and Microsoft reinvest in NVIDIA. So it's one big feedback loop. So those are just the financial sides of the AI narrative that I don't think are making sense. Doesn't mean that AI stocks can't continue to go up, but as Grantham recently said, NVIDIA is selling shovels in a gold rush. And the big buyers of this technology are the major concentrated S&P market cap holders. If they're making an overinvestment or if they're spending too much and assuming too much and pricing in too much perfection, they're just setting themselves up for a real uh-oh moment. And if some of these major tech stocks that have 40 to 50% collectively of a market cap of the S&P 500, which is really the S&P 10, if they malinvest or overinvest in AI, those stocks lose revenue. Those stocks go down. When they go down, they take the market down. And the market's the last good story in the US economy right now. So again, I'm not saying this happens tomorrow. I think we're really grotesquely overestimating the Trojan horse that is AI. I think we're ignoring the credit risk in subprime, and I think we're ignoring the risk in private credit on the market side. And so those are things that, again, you could spend hours on. But I also think, look, I think a lot of the AI is overpriced. NVIDIA tech going into China via Singapore. I mean, we saw that certainly the USA has an AI dominance, but I think it's kind of a joke because we're not alone. And we saw recently the earlier headlines when DeepSeek was the new hot girl in AI. When Sam Altman was spending $500 billion in AI, DeepSeek was spending about $6 million. So there's a lot of hype. There's a lot of, it's the new meme. It's the new, that's going to save us all. I think there's reasons why it's actually a far bigger Trojan horse, not just for market valuation, but for the man on the street. I think AI is very destructive. I think it's grotesquely overvalued. I think it's a bubble. It doesn't mean you can't trade it if you want to take that play, but it's do so at your own risk. But I think in the larger context of a major market bubble, the AI thing has me very concerned as well.
Yeah, and like you said, private credit is another big risk factor. You mentioned Jeffrey Gundlach already, and he says garbage lending means the next crisis will be in private markets.
Yeah,
it's just like you said. And do you think that in the end, and just like during the great financial crisis, the government and the central bank will be called upon to keep the bubble afloat? And will they listen to that call?
Well, that's what Sam Altman is effectively saying. And I had a conversation with Grant Williams a couple of years ago about the difference between success and wisdom. I mean, we have a lot of these young dragon slayers who are really tech, Cartesian-minded, the engineering types, who really think they can make a fortune by being tech, as if it's the salvation of all things. There's a difference between success on your balance sheet or success in your private checking account versus wisdom in the markets and what's really good for the economy and what's good for the nation. These are very individualist thinking. I think there's a lack of emotional maturity. When you see someone like Sam Altman effectively imply that, look, we're so important, I'm so important, that if anything goes wrong, we can always get the federal government to support this because we need it as a matter of national security. He's basically implying that. I don't think so. And again, that you could spend an hour on the debate of what really is AI. I'm not saying it isn't revolutionary. I'm not saying it isn't effective. I'm not saying it isn't a significant turning point in technology, but so was electricity. So was the internet. So were the dot-com movements. Again, I've seen this movie before. I'm very cynical about it. I'm certainly objectively seeing overspend, overhype, and overfaith in something. And I don't think that I think it's a very dystopian future. You know, when you talk about, Eric Schmidt writing a book about our human future, to me, that's the sign that it's not a very human future. It's a deflationary Trojan horse. Most of the VC conferences I listened to or attended, even those that are pro AI, see at least unemployment rates going past 10% in the next 2 years, because we can brag about a Starbucks that has 2 people and 100 robots working there, but what is that for the employment for the people that used to work at the Starbucks? That's a small metaphor. But as consumers fail, banks fail. I think AI is faster. It's not wiser. It doesn't have to explain itself because ChatGPT told us so. But if you look at the real numbers and look at the real facts, I mean, diagnostic robotics used AI for COVID diagnostics. They were no better than a coin toss. And the DARPA director used AI for detecting IEDs in war areas. Again, no better than a coin toss. It's faster mega computing. It's very disinflationary. It's going to lead to massive layoffs. I mean, look at Amazon. There's 160,000 employees they're not going to hire going forward to save $12 billion in AI workforce numbers. So again, there's lots of strings to pull on. AI is not necessarily going to save us. It's overpriced. It's being overinvested. It's being overhyped, in my opinion. And it can be the best of times for now, but like so many overblown stocks, certainly in tech, the best of times go from the sublime to the ridiculous into the worst of times. I'm not calling a top in AI today. I'm saying down the road, we're making short-term dopamine rush investments for the longer-term market bubble that I think is going to mean revert. No one, including Jeremy Grantham, myself, or Gunlach, can time a market bubble, but all of us can measure and track it. And there are any number of needles that can pop that bubble. I'm not here to predict it. I'm just here to say be careful about drinking the AI Kool-Aid to the point where you become literally blind to reality.
Can imagine, yeah. I can also imagine that just like banks basically held us hostage in 2008, saying you have to save us, otherwise you cannot pay anymore, and the whole financial system will break down, with the depression as a result, that AI becomes so entrenched within government systems and computers and how companies use it, that the AI companies can say, look, if you shut us down, if you don't save us, then all your systems will go down, or AI will turn against you. I mean, there are all sorts of tricks they can pull, of course, when they want to protect their wealth, their insane amounts of the money that they made over the years.
Sure, of course.
Interesting. And in, let's say, the bubble pops and AI could be the trigger, or private credits, we could see a huge stock market correction. What do you expect gold to do? I mean, in 2008, gold went up a little bit and the markets crashed. But in 2000, markets crashed, but gold crashed a little bit. What is your view on the performance of gold during a collapse of the stock market in the US, for example?
Look, this is a very important question, and it's one that Henrik Zeeberg has talked a lot about. I've talked with him openly in South Africa and recently on other podcasts. He's very informed. I don't entirely disagree with a lot of his views. We're all ultimately very pro gold in the long term. He sees a last dance for the dollar, but he also sees a blow off top in these markets. And using 2008 as a case study, he said gold can very easily retrace 30% in an moment in the S&P or the NASDAQ. And that's not an irrational argument to make. As someone who's very bullish on gold, I can't sit here and say gold will never really go down again. It's just going to go up. It can have significant retracements. As I said, it did in 1975, midway through a major gold bull market. What the argument made by Henrik and others is, which is rational, is when there's a major sell-off in equities, usually there's margins to cover. When you're losing money in your bad assets, you have to sell your good assets to get liquidity. And typically that can be gold. And we saw in 2008 a nearly a temporary but significant 30% fall in the gold price. So if there is another uh-oh moment, if markets ever do mean revert, and I think they will, it's just I can't time it. It's a very dangerous top to be chasing, but people still do it. I understand that. But if there is an uh-oh moment, whether it's driven by a recession or by a spike in interest rates or by an AI bubble or just a general slow build, lack of trust in a slow sell-off that becomes a fast sell-off, could we see a sell-off in gold? Of course you could. Do I think it could be 30%? I think that's less likely in a 2025 going forward scenario than in a 2008 scenario, only because gold's role, perception, and profile is so very different today than it was during the great financial crisis. That doesn't mean gold can't have a sell-off. But I think what we're seeing in the direction of gold as a strategic reserve asset, what we're seeing in the COMEX, what we're seeing in the petrodollar, what we're seeing with de-dollarization with BRICS, what we're seeing at the BIS by making gold a tier one asset right next to the 10-year US Treasury, none of those things were happening prior to the 2008 collapse. So gold has a very different position in the world today. Yes, I'm a gold guy. Yes, that's my bias. Yes, I'm apologizing for gold. But I think it's a very different backdrop for gold, a very different need for gold and demand for gold than it was in the 2008 crisis when we had the last real major sell-off. But does that mean gold isn't at risk? Of course not, because you will have to sell good assets to cover losses, especially to cover margin expenses if you've levered yourself. And markets are always, the highest risk is concentration, leverage, and timing. There's a great deal of leverage in these markets. So yes, that could be a buying opportunity for gold, but the secular direction, if you're holding gold as a strategic asset, as a better store of value than paper money, and you have confidence in its direction, you will be able to stomach any volatility in the gold price. I think much more than just a trader in gold or a speculator in gold, which will be squeezed out very quickly in such a moment. But if you're holding it for the long term, any kind of retracement in a market crash is just a buying opportunity, because the long-term direction as sound money, as a new direction in the monetary system, if you believe that, which I do, you can weather that. Certainly Egon, my colleague and partner, has been through many cycles since he started buying gold at 300 an ounce. He's never sold a penny because of a market move. He's never sold an ounce or a gram or a kilo of gold. He has that kind of conviction, but that conviction isn't because he's blind to risk. It's because he has a longer-term faith in the longer-term direction of gold as a new store of value. And whatever this new abnormal comes out of, this new reset to come, or this new disastrous kind of reshuffling of the chairs on the Titanic on the deck due to the grotesque levels of global and US debt. So, gold, all of us are kind of speculating on what role it's going to play. I don't think it'll be a gold-backed ruble or a gold-backed yuan or a gold-backed dollar. I think it'll be gold basically as collateral for repo markets, for lending, and certainly in the BRICS areas, gold as collateral for trade settlement.
So like Egon is sort of the Michael Saylor amongst gold bugs then.
Yeah, I trust him a lot more than Michael Saylor.
Well, you mentioned Henrik Seberg. I had him on the show 2.5 months ago, and he was expecting a blow-off top, and he also expected crypto, Bitcoin, to go to 160, 170,000. But we've seen the opposite, and we've seen crypto crashing with Bitcoin now at 20% down since I talked to him. How do you look at crypto, and to what extent is that also a sort of a signal that we're going to face a bigger crash in general, and not just crypto, but also stock markets, etc.?
Yeah, look, whenever a gold guy talks about crypto, the eyes start to roll, and I get that too. I think, in a lot of ways, I think it's too bad that the crypto and the gold community haven't figured out a way to at least, we certainly agree on a lot of the macro themes. We certainly agree on the destruction of fiat money through debt levels. I think a lot of the crypto crowd thinks that the gold community and guys like me and Egon don't get technology. And a lot of the guys like me and Egon think that the crypto crowd doesn't understand history. And so we kind of get into these loggerheads. But, I get that anytime a gold executive or a gold investor criticizes Bitcoin, it upsets a lot of the Bitcoin crowd. I think that's too bad, because I'm not anti-Bitcoin. Ronnie Sturfel, who writes the In Gold We Trust report, is in Bitcoin. A lot of folks I know
I like them both too.
I like them both too. I don't think you have to mock them, but I think I'm not, fully convinced on Bitcoin for a number of reasons. Not because I know the answer. There's just a lot of unanswered questions for me in the Bitcoin space. I do not think it's a store of value. I don't think it really will be. That's my view. I don't think it's just consolidating and it's going to become hard money. It's not hard money. I think they've done a very good job of using the gold Bitcoin coin to make Bitcoin feel like digital gold. It's not. But again, I'm not at the other extreme of a Peter Schiff or Jim Rickards. I think it's just a casino chip because it's got too much of a market cap. It's got too much momentum, and the Metcalfe's rule. It's got too much of a role. It was touted originally as decentralized. It's very centralized now. There's a lot of contradictions in it. But, in terms of what we're seeing in the recent price, and, I have a lot of very smart Bitcoin millionaires who come to Zurich and sell their Bitcoin to buy gold. That's just anecdotal evidence. And they know a heck of a lot more about Bitcoin than me. Most of them will agree that it is ultimately a risk-on asset. It is ultimately a tech asset, not a monetary asset. That will upset a lot of people. But I'm hearing that even from the Bitcoin crowd. But
so are you saying, like, for example, there's quite a few OGs, whales, Bitcoiners from the first hour that have been selling over the year. Some of that is also going into precious metals at companies like yours?
Yeah, again, that's just me saying what I say. That doesn't mean it's the truth. And you could argue he's just selling his book. But I can say honestly that we get a lot of Bitcoin millionaires who've run the run and now want to cash out a big position because they trust gold more going forward. That I got to say, though, if I had bought Bitcoin at 10,000, I wouldn't have had the guts to hold it to 20,000. If I bought it at 1,000, I wouldn't have had the guts to hold it to 10,000. So anyone who's been in Bitcoin long enough to make a fortune had conviction in it more than just as a trend, I think. So you can't poo-poo that. They have just like gold, an evangelical faith in Bitcoin. But the Bitcoiners that I talk to who have an open enough mind to debate or at least recognize gold's role, once they've made a lot of money, they'd rather save in gold than in Bitcoin because they're happy with what they made. Others want to wait till Bitcoin goes to 1 million, as Michael Saylor promises. It could, as Egon said, it could go to 0. It's a much longer to debate. But I think in terms of the price action in Bitcoin right now, one of the things I do know in the Bitcoin camp, and many of those who follow know that there's a great Bitcoin trader he's really looking at the 50-week moving average. That when you see a 50-week moving average and when the price goes below trend, then you get a long-term bear market in Bitcoin. And that's where we are right now. For whatever reasons, there's a lot of reasons people are saying that Bitcoin is falling below that trend. But technically, if I were just a trader in the asset, when you see it dip below a 50-week moving average, that tends to be a long bear market. For the Bitcoin evangelical, that's a buying opportunity, right? Yeah. And why is that happening? There are different theories on that. The Bitcoin crowd sees QE coming to the moon. That's usually a sign that things are going to get weaker. That usually is a sign that although QE should help the markets, that's a panic sign that we can see a sell-off in tech stocks or the NASDAQ. To me, Bitcoin still tracks the NASDAQ very well as a triple levered tech stock. That upsets the Bitcoin crowd. When you really see Bitcoin decouple from the NASDAQ and tech sector and behave independently on its own as a store of value or a unit of account or a true currency, so to speak, or alternative currency, that will be interesting for me. If I see Bitcoin decouple from tech stocks and decouple from the NASDAQ in a meaningful way, I'll have more to say about it. But as a speculation asset, you can't beat it. It had a 5,000% return, I think, in 2013. So its annualized return stretched out is fantastic. I think really, though, the East in China, and when I go to Singapore, I talk to Eastern investors, they see Bitcoin as a US dollar proxy or a vehicle to buy US treasuries. It's a pair trade with the dollar. It's a pair trade with Tether. Tether to Bitcoin exchanges, and under the Loomis bill, if you want to buy Bitcoin in the US, you have to use US dollars or Tether. That creates, ironically, demand for the dollar to get Bitcoin. So this anti-dollar, anti-fiat, decentralized crypto is actually being used by the government to create demand for its otherwise distrusted, unloved, weaponized dollar. And it's a very interesting model. And as a strategic reserve, I don't think it's really a strategic reserve. I think it's a bubble to pay down debts. It's the El Salvador model. El Salvador didn't use Bitcoin to buy anything in El Salvador. It was like 1% of transactions. But what El Salvador did brilliantly is speculate in Bitcoin, make a huge return, and use it to pay down debt. Thank God they got Bitcoin in the trend they did. They used the speculation in Bitcoin to pay down debt, just like the U.S. inflated the oil markets in the 70s by 400% to help create more demand for U.S. dollars. This decentralized anti-fiat, anti-government crypto is actually being used by the governments to speculate, to puff up, to pay down debt. That doesn't mean you shouldn't buy Bitcoin, though. They always say, don't fight the Fed, don't fight the government. If they want to use Bitcoin in a strategic way to create an asset bubble, that's fine, go long. I'm done with a lot of that kind of speculation. I don't mock those that do, but to call Bitcoin digital gold and to call it a potential new anti-fiat currency, a unit of account, medium of exchange, store of value. You can't have a store of value when its annualized volatility was 40% in November and 70% in March. Again, I just don't think that's a stable enough standard deviation to really be taken seriously. But the Bitcoin crowd will say, give us time, it's coming. And who am I to say? There's just a lot of things that are still unknown to me about Bitcoin. I'm not anti-Bitcoin. I'm not anti-speculation. Speculation what gave me the position to buy the gold that I did. I was very lucky, not smart, but I've gotten smarter since then, since I was in my 20s. And I just look at Bitcoin with a little bit more caution than I do gold. Certainly as a strategic reserve asset or as a savings asset, gold is my choice. That's just my choice.
Yeah. What I like about crypto, though, is that it scales so easily. Of course, there's sometimes there are too many transactions to be processed and everything. But in our space, in the gold and silver space, and we saw it last month, is that when retail FOMO actually starts, and we saw that, and there's just so much demand coming in that the whole supply chain is just sort of breaks down. Like you see delivery times going from 2 weeks to 6 weeks, 4 weeks. Refineries have short on staff, short on machines. And we still see some of that, even though November is a little bit more quiet. We still see delivery times of 50 gram bars for 4 weeks. And then during Christmas, between Christmas and New Year's, the refineries, they close. So that's the old school element of gold that I love about crypto, how it scales, how it innovates. And with the precious metals, it's difficult to absorb this huge demand, for example. And how do you see that?
No, of course, the portability and speed of Bitcoin is incomparable. This doesn't even come close with an analog pet rock like a big 400-ounce bar of gold. I was just in Zurich looking at a 400-ounce bar of gold. It's heavy. You can't walk into a car dealership with that, or even a Sotheby's where just buy a house. I mean, it's got the value, but it's a lot harder to then get the liquidity and convert it to fiat and then make the purchase. When as Voorhees said, I can sit here on my phone and in less than 5 minutes transfer 5 million. It's a little bit harder to do with physical gold. There's no doubt the technology behind Bitcoin for that type of speed and transactions is undeniable. I worry about counterparty risk. I worry about a lot of other things, but Voorhees is right about that. But still, old fogies like myself don't mind waiting a couple days to get liquidity from my gold stored in a hole in the ground in Switzerland. And if we're talking about larger amounts, that's just the choice we make. I think tokenized gold, when it becomes really effective and safe and counterparty free, I'm not there yet. That too is a discussion to come, but there will always be people like myself and Egon and our clients. If you don't hold it, if you can't see it, you don't own it, you don't trust it. You don't want to be subject to any system that has potential counterparty risk, not just technological risk, but even trackability risk or seizability risk. Things that are on the digital levered technology arguably are more at risk. But, again, depending on what hole in the ground you put your gold or where you store it, there's always counterparty risk. We try to keep it as old-fashioned and simple, stupid as possible by keeping it a hole in the ground in a jurisdiction where gold's a protected asset, where privacy is more respected than other jurisdictions. But of course, there's always counterparty risk. But we still are going to believe, and I think even in the future as technology grows, that the large amount of sophisticated gold investors will want their own physical gold that they can touch. They'll wait a couple of days for the liquidity because ultimately they're not transferring large amounts. They're not even looking at this as an asset to speculate in price movements. They want to save in gold and spend in fiat, just like the central banks in the East are doing. It is a better storage. It is a better store of value than any other asset. And I think that's the real case, regardless of technology, regardless of speed. We just want to save in gold and spend in fiat, whether that's in euros, Swiss francs, dollars, Australian, Canadian, American. Again, that's a high-class problem for wealthier investors who can put millions aside and save in it. And so there's a lot of different ways to look at it. There's no perfect way, but look, I'm not anti-Bitcoin, I'm not anti-crypto, I'm not anti-technology. Tech was very kind to me. I just see some of the risks, and I'm a little bit more old-fashioned, a lot more conservative than I was at 28 chasing IPOs with Goldman Sachs as a young punk,
I would love to visit your mountain vault, by the way, one day, because it has this James Bond vibe to it. So
it really does. It's really something to see. It's exciting.
Talking about technology, that's the interesting thing. Like China, of course, it's technologically very advanced. If you go to Shenzhen, it's just the West pales in comparison to China. At the same time, they don't embrace crypto, but they're embracing the oldest form of money because they're actively using gold, not just as a as a store of value, but they're also trying to collateralize it to use the SGE, the Shanghai Gold Exchange, in order to make gold also an integral part of the financial system. Could you elaborate on how we could actually start using gold in such a way? Because if we all put it in a mountain vault, it will be difficult to actively use it in the financial system. If we use stable coins backed by gold, that could be a possibility. But perhaps also if China sets up a series of vaults in different countries and dominates the system in such a way that at least all the trading partners of China can save in gold and spend in renminbi, for example, is that something that Eric Young, who I talked to last week, alludes to? Is that a system you could also see in front of you?
We're all guessing on what will happen when this bubble of epic proportion. I mean, again, we have in the U.S. 175 billion in unfunded liabilities. If you project 75 years out, we have 38 billion and counting in public debt. The CBO, the Congressional Budget Office, thinks we're going to be at 50 trillion by 2033. I mean, these debt levels are beyond abstract. They're beyond sustainable. And of course, that means the U.S. Treasuries themselves are going to be the IOUs behind those debt levels. And the U.S. dollar that's paired to that U.S. Treasury are losing confidence and faith mathematically. You can get past just weaponization in 2022 and what that did to the dollar. And what that did to the U.S. Treasury and what's going on with gold stacking sense. And when you're talking about Asia, using gold as collateral in the repo or using gold as collateral in the trade is obvious to them because sovereign IOUs, whether they're from China, from the People's Bank of China, from the Fed, or whether from the Bank of England or the European Union, they're less and less credible. They're less and less trusted collateral. And so you can see why China, which has a lot more authority, and by the way, China has so many problems. I'm not suggesting that China has it all figured out by any stretch. And you could literally spend an hour on all the problems that China has in this tug of war of currency debasement, trade war, currency war, hot wars. We're all kind of confused right now. China is looking more long-term in a chess-like way of, second, third derivative thinking about hard assets as better collateral than IOUs from broke governments. And will the West take that on when the IMF or the World Bank has the big reset that they've basically been telegraphing since COVID? Will gold or hard assets become a part of the system? The answer is yes. The IMF has already told us so in their great Bretton Woods 2.0. If you go to the website, literally Christina Georgina has it. It's this comical cartoon about blaming all of the debt in the world on COVID rather than the central banks. But regardless of that, and regardless of all the false data in there, what they've projected is a central bank digital currency for Europe and the West. The US has it in the form of stablecoin, not a Fed-backed central bank digital currency, but a fintech-backed central bank digital currency. So it gets wonky. But at the base of that pyramid for this new digital currency is physical gold in some coverage ratio. Tell me what it is. I don't know. I can't tell you. But even the West sees gold as some critical foundation to the reset to come because of distrust in sovereign credit, in paper currencies. They know to have a new digital currency, it won't have credibility as an e-yen or an e-dollar or an e-euro if there isn't a hard asset there. And that is obviously gold. In China, they're looking at gold as a net settlement for the BRICS and their partners. In regional currencies net settled in gold, they're talking about gold as collateral in their banking system. Certainly the retail side of China's ETFs has gone from 15 billion to 60 billion overnight in the last year. So you see at the government level, the citizen level, and the policy level, gold in the East is critical. You see in the West through the IMF and this reset to come, however that comes, and it's a million speculations there, but there's no doubt that gold is a part of that. In terms of the exchanges, the real question to me, and we can talk about some of the real problems in the LBMA markets or the COMEX markets, which again, the plumbing is meant to be complex for the LBMA and COMEX so that the average citizen doesn't understand it. We can talk about it, try to make it simple. The bottom line is there's a supply problem in the pricing and the leverage of gold and silver in London and New York. And now there's an exchange in China that has different price discovery for gold than in the West. And what does that mean for gold and silver? So there's all kinds of changes happening, but there's no doubt that precious metals are at the core of the discussion, whether it's Shanghai Exchange versus London and COMEX, or whether it's gold as a key pyramid foundational part of a new digital currency for the West, or whether it's gold as collateral for trade in the BRICS plus nations, the common denominator in all these conversations is gold, and to some extent silver, which I think is worth talking about. But the silver exchange and the silver tightness of supply and the free float in silver and gold and the incoming of gold in and out of the COMEX, again, very complex if you get into all the weeds, but the net is what we see standing for delivery, what we see in free floats, what we see in the availability of these metals and the stacking of these metals is a clear sign that gold in particular and silver as well is in massive demand and very tight supply. Of course, that's good for the price down the road of these metals, but it's really a signal of countries. Basically, I always use the analogy, if you're with binoculars in the military and you're looking across the river and you see somebody with a lot of tents, a lot of horses, a lot of cannons being rolled in, you see some smoke in the fires and you can hear the refineries making cannons. You don't need to be a military expert to see that somebody's planning on crossing the river. There's an invasion coming, And when you see what's happening in the silver exchanges in London, when you see what's happening in the Shanghai exchange or the SPIMEX in St. Petersburg, you see what's happening at the COMEX with this very, very strong, obvious desire to pull gold and silver out of these exchanges and into zip codes and private vaults. They're loading up on these precious metals, not because they think there's going to be more dental use or wedding rings or, just a price appreciation of the metal. It's because they see it as a strategic asset in a world that has monetarily shot itself in the foot after decades of overspending, overprinting, and debasing currencies. That gold and silver is going to be part of whatever the new abnormal to come is. And it will be very abnormal, very messy. I was talking to Wilhelm Middelkoop, who wrote The Big Reset. I mean, he used to think for years it could maybe be cooperative. And the new kind of normal that we're living in right now, there's not a lot of cooperation in the East and West. I hope there will be. None of us really know. But regardless of projecting or speculating, what I can say with a lot of confidence is gold and silver is pivotal to that new normal, abnormal to come, because paper money has lost its trust and credibility. And the evidence of that is literally everywhere.
Yeah, interesting. And of course, then layman would ask, but is there no way that the West, for example, could shore up its finances, and so in the end we would be able to solve our problems by just proper monetary policy or fiscal conservative policies. But last time you told me that not even Santa Claus can, or Mother Teresa can save the US or the West, and I guess that's still valid at point.
Well, again, it's just David Hume, 1750s. It's Reinhardt and Rogoff. It's von Mises. It's Sir Thomas Gresham, 1500s. When you get debt to such a level, when you cross that Rubicon of 100% debt to GDP, even if you're the world reserve currency, growth slows. So you can't grow your way out of this. The spending cuts necessary and entitlements, military, would be political suicide. I think they're talking about maybe gold revaluation, these 280 million ounces, valued at $42. If we let gold run to 4,000, to 8,000, 10,000, even 20,000, you can get 2 trillion, 5 trillion, 3 trillion in quick instant QE through gold. You don't have to print a bond. You don't have to issue a bond. You just revalue gold. If you let gold run and then revalue those certificates, you can get 1 to 3 to 5 trillion depending on the gold price. Many have said with a straight face, gold go to 20,000. If gold goes to 20,000 and we have 8,133 tons of gold and we revalue it at market, then we have 5 trillion in liquidity that we can throw into the TGA, which is Uncle Sam's checking account.
Yeah, but it would be inflationary, right? That would be a huge inflationary.
It'd be a massive problem for the dollar valuation too. I'm saying there's all these kind of ideas, desperate ideas to try and fix the debt problem. But the problem is there is no good idea. You can definitely say that Trump is certainly with his executive order is doing a lot more than Sleepy Joe Biden did for 4 years. And whether it's Doge, US aid, gold revaluation talk, a US-backed treasury like Judy Shelton is talking about, all of these things, or the External Revenue Service of tariffs, they're all active measures to try and deal with this crisis. But I'm saying, with all due respect, red or blue, that's not a solution. It's some Band-Aids on an open gut flesh wound. And maybe that's just me being cynical, but the debt levels are way past an easy solution. I stand by that 3 years ago. I stand by it 3 years from now. Some type of reset is inevitable, and some type of default has already happened because I think that we've already defaulted on our treasuries because they get a negative return when measured against actual inflation. And you've talked about maybe inflation.
Yeah, Trueflation, right? Because
Yeah.
I'm checking Trueflation, that website that basically tracks real time transactions and prices at retailers across the US. You think that's a good benchmark because there it seems actual inflation is lower than what the BLS is printing.
Well, look, I absolutely do not. And of course, again, that's my bias. I'm so negative that, of course, if there's a Trueflation model that says inflation is much lower than reported, then of course, it's going to be against my thesis. So I got to be full disclosure. I don't agree with this Trueflation data at all. You could say I'm data mining rather than data analysis. I still think shadow stats is the true inflation. I think John Williams is the true inflation. What true inflation is saying is they're trying to get away from traditional metrics and really trying to see the economy as it's been reshaped by COVID and M2 growth and fragile global supply chains. They're trying to find ways to make inflation less painful than it feels. It's kind of like a fat camp where you're getting fatter and fatter and fatter. You can see it. But the nurse at the fat camp says, no, you're actually losing weight, sir, because we don't measure calories from pizza or pasta or beer or chocolate. So yeah, you may be looking fat, but based on our metrics, based on our new metrics, you're actually thinner. And it's the same with inflation. No, you may feel like everything costs more and that your dollar has less purchasing power. But under our BLS model, which we've changed 22 times since 1980, no, you're actually not, things aren't more expensive. We'll tell you this enough. And so we've changed this scale so many times. I want to use the same scale to measure inflation today as we did in 1980 or 1990, certainly under Volcker, so that we have the same scale to measure this. It's like if I have a law school admissions test or an IQ test, and if I'm trying to compare it to somebody else, we have to be taking the same test. We can't have a different IQ test today than we did yesterday to measure intelligence. It has to be the same if we're going to measure relative intelligence. If we're measuring relative inflation, we have to use the same scale that we did under Volcker. And if we do, under John Williams' analysis, we're looking at 10% inflation right now. That's not tweaking it like the BLS does or like true inflation does to make the obvious seem less obvious. Let's just, whether you believe in the scale used in 1980 or not, we have to use the same scale. If I take a law school admissions test that's 20% easier than my peers 5 years ago, I'm not the same lawyer and I don't have the same IQ. If we use the same scale to measure what we've done to the dollar and the purchasing power of the dollar, we're at 10%. That means we're losing 10% in purchasing power a year. That means every yield you receive from a T-bill to a 30-year note, or excuse me, a 30-year bond, you're getting a negative return, which is exactly what the government wants. They want negative real rates so they can inflate their way out partially of this debt, and then they just lie about the inflation. That is as old a trick as you can use. And of course, the BLS is always right, even though they're never correct, because it's the official number. I'm saying, and by the way, this is something that Charles Goodhart, a U.S. economist, says. He could spend, again, an hour on this, whether it's growth, employment, or inflation. It's always a lie once it becomes politicized. And that's what you do to survive. Jean-Claude Juncker, former president of the European Commission, when the data is bad, we lie. Again, that may sound sensational, but let's keep it honest. Use the same scale to measure inflation under Volcker as we do today, and we have significantly higher inflation than is reported. And of course, the government, I'll just say it, lies to avoid the embarrassment and to continue to run negative real rates to inflate away part of this extraordinarily grotesque debt levels. That's how I see it.
So they should remove the L from BLS then, right? Just call it BS.
I've often called it that, the BS standard.
Yeah. Well, I don't think you're cynical. I think you know your history, and that's why you're skeptical that governments are able to turn the tide. And I also think we should probably prepare for the worst by protecting ourselves, our loved ones, and our wealth by making the right investment decisions. Yeah. So thanks so much, Matthew, for being on the show again. I highly appreciate it. Where can people find more about you?
We're at vongreyers.gold or goldswitzerland.com. All interviews like this and articles we write are there. There's a lot of really free education. I know that not everyone can become a client, but I am certainly very committed to trying to teach people history, to try and teach people basic math. Yes, I'm very cynical. I don't think the government is your friend. That's my bias. That's my premise. Take it or leave it. But I try to be as objective as I can in showing the data, so you can get a free education, you can get informed, you don't have to agree with everything I or Egon or Ronnie Sturfler or we have Alistair McLeod now as an advisor and Grant Williams. We have some really, I think, sober thinking, honest thinking brokers here to talk about history and math of why gold and also how to own gold. There are many different ways to look at that. You don't have to become a client to get that education. I've always said, challenge our assumptions, challenge my assumptions, but at least get informed. Information is more power than gold and silver. Being informed helps you stay sane in these kind of insane markets and insane noise and fog of so many different views. It's really hard to find a view that resonates. Ours is just one view, but it's supported by a lot of data, a lot of facts, certainly a lot of conviction. But, between Egon and Alistair and Ronnie Sturfel and Grant Williams, I'm surrounded by really brilliant minds. I think we're being as blunt as we can. But yes, we have a bias and conviction in precious metals for sure.
No, I always tell my viewers the same thing. Do your own research. Don't just accept anything for granted, what either Matthew or myself share with our viewers. So thanks so much for your free education. I understand your frustration that you cannot serve the whole world, but I also like the fact that you guys focus on a certain segment of the market, and people can always enjoy your research and these podcasts. So thanks so much, Matthew, and let's do it again in a few months or so.
Okay, Paul. Thank you.
Okay, take care. Bye.
Cheers.